Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to level production versus seasonal production, comparing and contrasting the two. Get ready, it's time to take your chance with Corporate Finance. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to do so, but if you have access to it and would like to, we are in the 615 level production versus seasonal production tab in the practice problems section. Closing this back out, we're going to go through the information up top, and then we'll have a smaller view of that information we can use to go through the practice problem. Our basic scenario is that we're going to be manufacturing or purchasing inventory that we are then going to be selling, and we're going to be financing that inventory. And there's two kind of ways that we could think about the production process. We could try to line up the production process to exactly what is going to be happening in the sales lineup. And if we do that, then we're going to try to have kind of like more of a just-in-time type of system. We're going to have exactly the inventory that we need to accommodate the sales that will be taking place. Or we can try to estimate what the total sales will be over that time period, and then try to make a production process that will be even in order to meet that 4-month time period. Now, there's pros and cons to either of these types of methods, but we're also going to be thinking about the financing of it. So we're actually going to have to finance either the purchase or the producing of these units. So the concept is that we're going to be saying that we need to produce or purchase certain units that we think are going to be sold. We're going to estimate that we're going to be financing it, taking out a loan in order to do so. If we pay back the loan in the same month, or by the end of the month, we're not going to have any interest charge on it. But if we don't pay back the loan, meaning the ending inventory that we have not yet sold, we're going to have to keep the loan outstanding. We're going to be charged interest on that. So that's going to be our basic scenario. So let's think about this. We've got the unit sales for the 4 months, October, November, December, and January. You can see that our highest month is December, so that's going to be our peak month. We have a seasonal type of business that peaks out in December. Now, these are the units that we're going to either purchase or that we're going to have to purchase and then sell, or we're going to have to make these units, whichever you want to think about. But we're going to have to finance either one of those type of options that we will then have. So we could do this in a couple different ways. We could say, hey, look, these are our projected sales. We're thinking out into the future. These are our projected sales. Because I want to limit the amount in ending inventory and limit the financing charges for them, I could try to produce or purchase exactly the amounts that will be sold here, or pretty close to them or closer to them, meaning having, purchase less units here or make less units here, purchase more units here or make more units here. And in doing so, we'll lower the financing charges and we'll lower the amount of ending inventory, lowering the cost of having to, stock the inventory. So that's one method we could use, and different types of industries may be more inclined to that method. For example, if we have a close relationship to our supplier, or if we're able to produce these things fairly quickly, then we might be more likely to do a less inventory type of method. We could bulk up the production when we need it, and that might be a more reasonable type of option to do. However, if it takes more time to produce these types of things, if we don't have as close a relationship to the supplier, it takes a little time for us to get the inventory, we want to make sure it's on hand to sell it, then we may be in an industry where we want more of a cushion. Also note there's going to be a difference in terms of the production process. Obviously, if we had more of an even production, if I was to try to say, for example, instead of meeting the sales needs exactly, if we then said, hey, let me see this 15,900 total, pull out the trusty giant calculator. The calculator gets excited when I pull it out, so it has to be all big like that. But then we're going to take the 15,900 divided by 4. We could say, hey, why don't I just try to produce evenly the 3,975 per month? And in doing that, then our production process is going to be uniform, and that can be easier to standardize. So if we're going to hire people, for example, in order to help us to produce these units, it would be nicer on them if we could standardize the number of hours that might be needed to hit this constant level, rather than trying to spike up on the seasonal times. And if we were to do that, then we can kind of even things out, but that will result in us having most likely overproduction in the short months here that will then even out once we get to the peak times. So those are kind of our two methods. And so we're going to think about, well, obviously, if we were to try to meet the sales exactly, we may not hit the sales exactly. We may miss some sales in that case, but we'll limit the financing costs. And obviously, if we were to do that and we were to line up exactly, we guessed exactly what the sales would be, we would have no ending inventory and we would have no financing costs, and that would be great. Let's think about, well, what if we took the even approach? What if we said, hey, I think we're going to have the 15,900, let's produce them evenly, and then think about the financing cost that could be resulting from that. So we're going to assume the use of seasonal production will result in inventory directly matching sales each month, resulting in no inventory buildup. If we have level production, we are less likely to run out of inventory, but we'll need inventory buildup. And so that's what we'll calculate here. What is the ending inventory for each method? Inventory cost is going to be $5. We're going to purchase inventory is financed with a line of credit. So we're going to finance our inventory that we're going to purchase entirely with a line of credit. The loan will be paid back with sales each month. So we're going to pay back the loan as we go. The outstanding balance will be the result of the unsold inventory. So when we have the unsold inventory, we didn't sell it. So therefore, we're not going to pay off the loan related to the unsold inventory. The interest rate is going to be 14%. Here's a smaller layout of that data that we can use then to go through our practice problem. So we're going to go through our worksheet here where we will have the month, the units sold, the units produced, and then we're going to have the change in inventory and then take a look at what will still be in ending inventory. Our scenario is going to be that we're going to assume that we're going to have 15,900. That's our projected sales in units at the end of these 4 months. So we're just going to take that 15,900 as we saw on the trusty calculator, divide it by 4, and then we're going to produce evenly 3,975, even though we're predicting that the sales will be different for each month so that we can standardize our production process, resulting in us less likely to run out of inventory due to us having some ending inventory left, and it could simplify our production process, make our hours of production easier, not have to adjust the hours of production and labor possibly as much this way. So then we're going to say, okay, October, the units that we're going to sell 2,000, we're going to produce that 9,000, that 3,975. That means that we are going to overproduce. The 3,975 minus the 2,000 means we have overproduced and therefore have ending inventory, increasing ending inventory by 1,975. So ending inventory would then have the 1,975 in it. Then in November, we're going to say that we're going to sell 3,000 units. We're going to produce once again that 3,975. 3,975 minus the 3,000 means we're going to overproduce 975, and we already had in beginning inventory 1,975. So 1,975 from last time that we overproduced plus the 975 means that now we have to store this 2,950 of inventory that we have not yet used, but we expect to use because now the big month is coming up. That's going to be the month of December when we make most of our sales. So that means in December, we're going to sell 5,900 of these units. This is our big month. We're still going to produce only an even amount, 3,975, but that's okay. We planned on that because we already have our beginning inventory to cover us here. So the difference now, we underproduced by 1,925, but that's okay because we already had beginning inventory, 2,950, that we're now going to eat into. So 2,950 minus the 1,925 that we underproduced in December leaves us still with ending inventory of 1,025. And then in January, we're going to say that we had the 5,000 units here. We produced, once again, the 3,975, meaning we underproduced in January by 1,225, the 5,000 minus the 3,975. But we already had a beginning inventory of 1,025 that will then net out to 0, ending inventory 0 at the end of the day. So if we tried to guess exactly and what the inventory would be and we were right, we would never have ending inventory. That would be more like a just-in-time kind of system, or us guessing perfectly what the ending inventory would do and producing at that rate. If we were then to try to average it out, we'd still end up at 0 if we tried to do it perfectly at the end of the time period, but we would have this inventory along the way, which could help us in case of problems along the way. If there's any supply problems and whatnot, we could still have some cushion on the inventory, which could be useful, but we'd have to finance it. So now let's consider the financing. We're going to say, all right, on the financing, we're going to say in October, we wanted to produce this 3,975 units. We're going to finance the entire thing, the cost of the production of those 3,975 units, but we're going to pay back the loan for the units that we sold, right? And the units that we did not sell are this 1,975. We didn't sell those units, and therefore we're going to have to pay the financing related to those units. Now the cost of the financing is going to be, the inventory cost per unit is $5. So we're going to say that we had the 1,975 times $5 that is going to be the cost of that ending inventory, which is going to be that 9,875. And then we're going to finance it. We're going to finance it with 14%. So that's going to be our rate. So I'm going to say times the 0.14, and that would be if it was for a year, divided by 12, and that's going to be the 115. Now note that can be a little bit confusing. So note this rate up top. There's a couple ways you can think about this rate. I usually calculate the year's rate whenever we have an interest rate. It's for a year unless said otherwise. And then we have to break it down to a monthly rate. You could break it down to a monthly rate first, which is 0.14 divided by 12 months. But notice that monthly rate is so small, that's why we don't usually use a monthly rate. We usually use the yearly rate. So notice what we did is we calculated the interest as if it was a year, then divided by 12. The other way you can do it is to divide the interest rate yearly and break it down to a monthly rate, which we pretty much need all the decimals. You can't round too much because it can have a significant impact. And then multiply that times the loan amount. You'd get to the same 115. Remember that this is a rounded number, so we do deal with rounding here. And then in November, we had the ending inventory of the 2,950, which includes, the prior month plus the overproduction in November. And so if we did the same thing here, we've got the ending inventory, the 2,950, and then times 5, because that's the cost per unit. So the 2,950 times 5, that's going to give us our 14,750. Now let's do this the other way this time. I'm going to take the 14%, 0.14, divided by 12. That would take the yearly percent, breaking it down to a monthly percent, and then multiply it times the loan amount, 14750. That's going to give us about this 172. Then if we were to do this again in December, we had the outstanding balance that we had of the 1,025. The 1,025, if I take that 1025 times 5, that's going to give us, because $5 per unit, that's going to give us the loan amount of the 5125. And if I do this times, I'll do it this way this time, the 14%, 0.14, that would be for a year. We're going to take that and divide it then by 12, and that will be the 59, about the 60. And then we have January, and January we don't have any inventory, so that's going to be 0. 0 times 5 is 0, and 0 times the monthly percent is 0. So then if we added up the outer column, the 115, the 172, the 60, we're going to get to that 347, and that would be the financing options here that we would have under this kind of even method. And obviously if we were trying to guess exactly, we wouldn't have any financing. So let's do that one more time. Let's do it again. Similar kind of problem, different numbers. So now we're going to say the unit sales for the 4-month period, March, April, May, and June. You can see that May is our spiking month. That's when we do our best job. That's when we get the most sales. So the option is then, if we're going to make or buy the inventory, do we make or buy them exactly and try to meet these exactly? And there's pros and cons to do that, because if we're going to finance the purchase, then if we can meet the and not have any ending inventory, then we might not have any financing charges in order to do that. If we can pay back within the same month, basically, then possibly we could say we don't have the financing. But if we have to carry the inventory and hold on to inventory, then we may have financing. Now that we're gonna need to take out the loan. Or we take a nice even method here and say, hey, look, I would like to make this an even process. I want to evenize my production process. I want to make it easy on basically workers so that we can then possibly have a set hourly rate that can be a little bit more predictable by making a fixed amount each month. And that'll be kind of a more systematic, easy way to do it. And it might be a little bit easier for us to be holding on to some ending inventory in these months so that if we're low, if we're short, we have a bit of a cushion. We might be able to pick up some added sales if sales happen to be higher than what we predicted them to be. So obviously then we could try to do an average method, the 3,000 plus, or we already have it summed up down here. I don't need to add them up. 31,300 divided by 4. And we could just say, I'm just going to make 7,825. I'm going to overproduce, and then underproduce and eat into some of my inventory, and then do the rest down here, and that'll bring us back down to 0. Those are our two basically options that we're considering. And then scrolling down, assume the use of the seasonal production will result in inventory directly matching sales each month, resulting in no inventory buildup. If we have level production, we are less likely to run out on inventory, but will need inventory buildup. What is the ending inventory for each month? Inventory cost per unit is going to be $12. Purchase of inventory is financed with a line of credit. The loan will be paid back with sales each month. The outstanding balance will be the result of unsold inventory. So we're going to finance what it costs for us to basically produce whatever we're going to produce. And then we're going to pay it back in the same month and not incur any financing charges if done so. If we don't pay it back, then we will incur financing charges, that being on the amounts that are still in ending inventory. All right, so here's a smaller breakout of our data. Let's use it to work through our practice problem again. So we got the month of March. We think that we're going to sell 3,000 here. And then we nice evenly broke this out. Once again, we're going to do an even breakout, make it nice and easy on people, make a systematic thing. Hopefully we can be a little bit more dependable to do that with our workers and whatnot, and have them have some hours that they can rely on at the 7,825 units that we're going to produce, nice and evenly over the 4-month time period. And then we have the difference then. That means that we're going to overproduce in March by that 4,825. That's going to be in our ending inventory in units, but that's okay because we're waiting until May that's when we sell a lot. And then in April, we've got the 7,500, that the units that we're going to sell. We're going to produce once again that 7,825. The 7,825 minus 7,500 means that we have now overproduced by the 325. We overproduced last month by the 4,825 plus the 325 we overproduced this month gives us the 5,150 that we've overproduced by. That's what's in ending inventory at the end of April. Then we're waiting for May. That's our big month where we're going to sell 11,300 units. And we're only going to produce 7,825 because we already have this 5,150 in ending inventory, which is going to help us out with the underproduction. So we don't have to go crazy this month, like producing like crazy, because, we did an even method here. So the 11,300 sales minus the 7,825 means that we underproduced by the 3,475. We had in beginning inventory, however, 5,150. So the 5,150 minus the 3,475 means we still have in ending inventory 1,675. And then finally in June, we're going to sell that 9,500. We're still going to be producing, just cranking out just a normal production month here. 7,825 units. The 9,500 minus the 7,825 means we underproduced by that 1,675, which, because we were perfectly estimating here, is equal to what we had in the beginning inventory, bringing the inventory down to 0. Now we had to finance these ending balances here because we were not able to pay back the loans within the month, within our line of credit. Therefore, whatever is in ending inventory that we had to finance, we're going to say that we had to, pay the interest charges on those amounts. So what's that going to come out to? We're going to say, all right, we had in March 4,825, and we said that it costs inventory per unit is $12. So we're going to be picking up then that 4,825 units, which cost $12 per unit. That's going to be 57,900. And then the rate is 8%. That's a yearly rate. So if I multiply times 8%, 0.08, That would be if it was for a year. We're going to break it down to a month now, dividing it by 12, because there's 12 months in the year, bringing it to 386. And then in April, we had ending inventory up here of the 5,150, 5,150. That's in units, 5,150. To convert it to dollars, we'll multiply times 12, because there's $12 per unit that it takes to make these things that we're making or buying. And that's going to give us to the 61,800. Let's do it this way now. We're going to then have a loan on that amount that we're having to finance. That's going to be the 0.08 interest rate. Let's divide that by 12 to break it down to a monthly rate, which is awfully small. That's why we don't do it that way, because that's like 0.66 monthly rate. But then we're going to say times the 61,800, and that's going to give us the 412. The 412. And then in May, we had ending inventory of the 1,675. So if I take that 1,675 times the $12 per unit, we get to the 20,100. That is the loan that we're going to need to be taking out. We're going to multiply that once again times the 0.08. That's the interest rate for a year, dividing that by 12 to bring it down to a monthly total. That brings us to the 134. 134. And then in June, we don't have any ending inventory. And if you multiply 0 by like anything, then it's 0. So we got zeros all the way across. So then our financing is going to be that 386 plus the 412 plus the 134 for a total of the 932 total.